Hi everyone, I hope you're all doing very well. Today we're going to be looking at three different companies I'm following at the moment. So normally when I post an update to you guys, I pretty much post an update of a company that I'm ready to invest in. In a lot of cases I've been following that for 6 or 12 months. And so if you look at Discovery, I've been following it for several months. If you look at Nokia, for argument's sake, I've been following that since last March. It's trading at 4 times enterprise value to EBITDA, but had no catalysts, and therefore I didn't get involved in it. A lot of these companies I follow for months before I get involved in them. And as of right now, there are three companies that I'm very interested in at the moment. Not ready to take the plunge and buy into them yet, but they're potential candidates that I might invest in at some point later this year. Right? And so what I'm going to do with you in today's update is share what I like about these companies and what I want to see moving forward. So we're going to have a brief overview of the three different companies. They're completely diversified. We have one cellular company, we have one browser, and we have one home builder. The home builder is probably closest. You could probably invest in the home builder right now, in my view, because we have a number of catalysts at the moment. I personally just don't have cash available at the moment, but I find this specific home builder, which I'm sure you guys can see already, it's Toll Brothers, very appealing at the current prices. Anyway, let's get straight into today's update. Let's start off with some of the macro reasons for liking home builders right now. So as you guys know, in the United States, we've got pricing pressure on the upside. That's driven by supply side constraints, but it's also driven by demand. If you look at demographics, millennials are now hitting 40 years of age. At 40 years of age, they've grown up, they've got married, they've had children, and they're in leadership or management roles within their job. They're in their highest bracket of earnings between 40 and 55 years of age, and at the same time they're about to settle down. So if we have a look at this chart here is housing starts. So the Census Bureau for building releases 3 data points every single month. They've got building permits, housing starts, and housing completions. So permits obviously is requesting planning permission. And then you have housing starts. The definition of housing starts is the foundation is built. So of all of these, there's 1,500, I think it's million, 1.5 million housing starts in the last month. That's 1.5 million foundations that have been already laid. That's what characterizes a housing start. So this is actual supply coming online at some point in the future. And as you can see, after the financial crisis, we had a massive crash in housing supply that never really came back online. And now we've got a headwind regarding supply. At the same time, we have demand coming online with millennials coming of age. So we have supply and demand side shocks, which is causing prices to push higher. I don't think we're in a bubble yet, but I think we might turn into a bubble at some point over the next couple of years. And that's the risk that I see in the housing market at the moment because of the supply-demand nature of what we're seeing in the housing market. However, this just gives pricing power to home builders, and it should be a longer-term tailwind moving forward. So, as you guys can see at the moment, this is trending higher. Supply is coming online, albeit at a slower pace, but I do think that this is going to continue on the upside with the supply-side constraints that we currently have. The reason why I don't think we're in a bubble is because when we have a look at household debt service payments as a percentage of disposable personal income, you can see that it's pretty much at an all-time low. So this goes back to the 70s, and you can see that it's at 9.4%. So we're pretty much at an all-time low here for household debt service payments as a percentage of disposable income. And what that gives us indication for is that housing is not as unaffordable as what a lot of people think. And the reason being is interest rates are so damn bloody cheap at the moment. So the cost of money is so cheap. At the same time, you're seeing wages increase at a faster pace. So people are making more money and the cost of debt continues to depreciate, meaning that the household debt service payments is pretty close to an all-time low. So housing, although the prices are pushing higher, generally speaking, it's still very much affordable. And I think it could go into a bubble, giving home builders massive pricing power. So that's really the macro backdrop that I really find appealing about home builders at the moment. I personally like Toll Brothers, and the reason why I like Toll Brothers is because they got really good margins. It's a prestigious brand, and because housing is so cheap, I think that the luxury market should continue to do very well. As well as that, forget about what I think personally. Analysts who do an awful lot more bottom-up work on this are forecasting very strong growth this year and next year. 23.5% growth on the top line this year, 19% next year. That is fantastic growth for the current fiscal year and for the next fiscal year. Let's have a look at free cash flow generation, because this is what's throwing me off a little bit. If you look at free cash flow over the past number of years, so 2021 is anticipated to be $790 million. And given that the enterprise value is $10 billion, that's about a 7.8%, 7.9% free cash flow yield. That's fantastic. And you can see in 2020, free cash flow yield was pretty darn close to $900 million, which at current valuation would have been about a 9% yield. But that drops down to $315 million, and it's not because of capital expenditure. Yes, capital expenditure has increased. It's increased by $21 million, but free cash flow has dropped by $450 million. And I don't know where that went, because if we have a look at net income, you can see that the net income is actually forecasted to be very strong in 2022. So I don't know if that's a rounding error here from the analysts, or whether the platform has come up with the wrong number. But I can't explain why free cash flow has dropped to $315 million next year. And although I've only skimmed through 10K, I can't find a reason that suggests the free cash flow should be dropping to $315 million. Everything is looking very, very, very strong. And you can see that we have a tailwind regarding margins here for EBITDA. Across the board, EBIT and net income is continuing to push higher in terms of margins. So the margins continue to expand. Capital expenditure is not really increasing material, yet the free cash flow yield next year is going to be a lot lower, because it's forecast to be $315 million. I don't know if that's correct or not. So if we do settle somewhere around $700, $800 million in free cash flow, relative to where the current enterprise value is, it's about a 7.5%, 7.8% free cash flow yield. To me, that's a really, really, really good, strong number. And that's what I really like about it. So when I'm looking at Toll Brothers, it's a solid balance sheet. So if you have a look at their balance sheet, they've got plenty of free cash flow to service their debt. But they also have $714 million on the balance sheet in cash, which I think is, obviously it's fantastic. But when you're generating $700 million plus in free cash flow, it's absolutely beneficial. Actually, if we pop on over here to estimates, we might actually see that the net debt's coming down. So maybe they're going to pay down their debt. So we have a look at net debt. It's coming down a little bit. It's coming down by about $300 million. There you go. That's probably what it is. Slight increase in capital expenditure, and the company are probably going to pay down about $300 million in debt. So they're going to continue to clean their balance sheet up. But the balance sheet's not really a problem, because the net debt to EBITDA is currently at 1.18x, and it's going to drop to 1.3x next year. So strong balance sheet, strong free cash flow generation, macro tailwinds. That's why I really like Toll Brothers at the moment. There's a number of different reasons why I support the share price pushing higher. When we overlay that then with Elliott Wave, and as you can see obviously here from the bigger picture, this drops down in an A, B, and a C. So that's corrective. We knew off the lows it should make a new all-time high. I should have bought into this last year, but anyway, it is what it is. There was plenty of opportunities last year. So the way I'm actually measuring this, I think that the company is still currently fairly cheap. It's currently trading at about 7 times enterprise value to EBITDA. And what I find interesting about that is, before we actually move on to the chart here, it's below its longer term average. So if you have a look at enterprise value to EBITDA versus next year, obviously after the financial crisis, a little bit skewed. But if we take that out and we have a look at more normal numbers here, the average is about 9.5 times enterprise value to EBITDA, and we're currently trading below there at 7.3 times. So I think you could see multiple expansion back up to at least 9.5 times enterprise value to EBITDA, meaning that there should be upside outside of growth. So I still think there's more upside from a fundamental perspective, but I also think that there's going to be margin expansion as well. If you have a look at the chart structure here, it's looking like this is going to be an extended fifth wave. So we have wave 1, wave 2, 1, 2, 3, 4, 5 for wave 3, WXY for wave 4, 1, 2 diagonal here for a wave 1 within a wave 3, 2, 3, 4, 5, 4, 5. So when we're looking at the chart structure of Toll Brothers, both from a fundamental perspective, a valuation perspective, it looks really, really attractive at the moment. The 1.618 extension brings us up to 92, but if we fully project into the future what the expectation should be, it should be up around 125 to 130. And at the current price of $57, that's about 100% on the upside. Yes, it might take 1-2 years to play out, but the return relative to what you should expect from the market is going to be above and beyond expectations. So home builders in and around here, naturally I'm quite excited about them. So first and foremost, Toll Brothers is a very interesting play for me, and that's what's on my list at the moment. So again, what I'm trying to do here is just share my thought process, how I build out these ideas, what I look for, and so on. So with Toll Brothers as well, the reason why I say this one could be ready pretty soon, and I've been following this throughout the correction, I was a little bit apprehensive regarding getting into this because of interest rates rising. Wanted to see how it would affect the housing market. Didn't affect it much. Demand versus supply side constraints is far too strong. But as you can see here, this breaks down an A, a B, and a C, which looks to have completed off its wave 2. If you go into the lower time frames, go into the 5-minute chart and you have a look at the move up off the low, you can see that this has moved up in a wave 1, 2, 3, 4, and 5, A, B, and C. So what I'd be looking for here, if I was to enter into Toll Brothers, if I have a position that goes horribly wrong in the next couple of days and I need to reallocate that capital, a break above $59.62 would get me involved in this, and I'd be anticipating new all-time highs above $68, $69. But more importantly, I'd be focusing on 12 to 24 months into, 12, 18 months into the future, even 24 months into the future, and I'd be targeting 125 to 130, following the macro environment, following the valuations, following the earnings report, essentially, to make sure that they're staying on target. So Toll Brothers is number one. Second one we're going to look at is, we're going to have a look at Opera. The Forgotten Opera. This is really, really, really interesting. So Opera is currently trading at $1 billion enterprise value, right? So they got almost 150 million in cash on the balance sheet. So it's trading at 1.05 billion in enterprise value. Let me give you a little bit of insight into this company. Maybe they have it here actually. I got it from their 10K filings, but essentially they own a stake in a fintech company called OPay. They own about 13% of the company, and that's growing at a rapid pace. And so as that continues to grow, it should benefit Opera. So I found that very interesting. Second thing I found very interesting is some of the assets that they have. So they have an AI generated content curator. They have another platform which is OPay Gaming. So they've got a gaming platform, AI content distribution, and OPay at 13% ownership of the company. They have 370 million monthly active users. So it's not really present in the United States. It's more present around Europe and Asia, but they got 370 million users. And at the same time, they have it's $1 billion in market cap. So if you look at Twitter, they've got more monthly active users than Twitter. Twitter have about 199, 200 million. They've got about 50% more monthly active users. And at the same time, Twitter's priced at about 30 billion. So I found that really interesting that they have access to 370 million people. And at the same time, they've got a gaming platform, AI content distribution platform, and they've got a stake in a fintech corporation, which I found very interesting. So let's have a look at their balance sheet first and foremost. So we're paying $1 billion and 50 million for this company, which I think is absolutely dirt cheap. The balance sheet will show, into financials, balance sheet. The balance sheet, as you can see, there's $143 million on the balance sheet. So although they are investing, not a huge amount, but they are investing, and they do have that stake in OPay and their gaming and their AI content distribution, they're spitting off a lot of free cash flow. If we pop on over here to cash flow, you guys can see cash from financing is negative. So they're repaying debt. So they paid $57 million in debt, and they repurchased $49 million last year in stock. So they've paid down debt and repurchased stock to the tune of $100 million over the past year, and their operating cash flow is still $93 million. If we pop on over here to their estimates, this is what I find really interesting. Just to be very clear, I thought Opera was a dead business. I remember Opera in the late 90s, early 2000s. I think this was the browser that we were using in our house. So like, this is not a new company. This is an old company that I thought had already gone bankrupt. But in 2021, they're anticipating 44% top line growth. In 2022, they're anticipating 19.1% compounded. This is not the sign of a dying business at all. This is the sign of a thriving business. Over the last number of years, the revenue in 2017 has gone from 128 million, and it's guided to be 283 million by 2022. So it's an older business that's obviously revised its growth by consolidating into different niches such as gaming, AI content distribution, and OPay, as well as having access to 370 million users. So we're paying $1 billion for next year's revenue at 283 million. This is where it gets really exciting for me. When you have a look at free cash flow generation, $62 million next year is about a 6.2% free cash flow yield. You're getting a 6.2% free cash flow yield for a business that continues to spit out fantastic amounts of cash flow. It doesn't have a dividend, but they spit out this free cash flow, and what they're doing is buying back their shares. So the valuation should remain low for quite some time, in my view. And I find that really, really, really appealing, given the growth that we're seeing in this company. What else did I want to mention about this company? Its valuation. So 6.2% free cash flow yield. Let's have a look at its valuation. It's trading about 20 times next year's enterprise value to EBITDA, showing up here as 35. Why is that? Let's have a look at next year, 46 million. So 1050 divided by 40. Whoops. Pull up my calculator first. 1050 divided by 46. Yeah, 21.87. So maybe they're calculating it against 2021's number. So enterprise value to EBITDA is trading at a 21x multiple, but it's got really, really, really strong growth. So moving forward, that's what's really appealing to me. This is a business that very few people are actually following at the moment. In my view, a 21x multiple enterprise value to EBITDA for a company that has a call option, an OPay, an iGaming, AI content distribution, 370 million monthly active users, growing top line revenue, strong double digits, has free cash flow generation, is buying back shares. To me, that's a fantastic opportunity. Over the next decade, I think this company could be worth in excess of 10x what it currently is. This is one of those companies that I'm considering buying and holding for a long time to see where it goes. The numbers that they're producing are absolutely fantastic. And what's clear to me from reading their 10Q and 10K filing is that the company recognizes it's going to be very difficult to compete with like Google or something like that. And they've consolidated into niche markets, which has been very, very, very successful for them. So moving forward, I think that this is definitely an interesting play. And again, it's one that I'll continue to follow. If it gets cheaper, absolutely, I'm going to take a bigger stake. But I think you guys would agree that it looks very interesting at the moment. So this is Opera, OPRA. There is one downside that I should mention. There is absolutely one downside to this. The downside to this is a subsidiary. Its parent company owns 51% and the CEO has a further 13%. So 64% of the company is consolidated among two different owners. And because more than 60% of the company is consolidated among two different owners, they are exempt from certain corporate governance rulings. So if we're going to get involved in this company, we can't complain about how the company react or communicate or anything like that. We just have to bet on the jockey in this case. And when you're looking at the numbers that the management are producing, it's hard not to bet on them. So that is one downside. That is absolutely one downside, that the ownership is very much concentrated, and that might explain why it's very cheap, but it's performing very well. So if you have a lot of conviction in the management, this could be a very, very, very interesting play. The way I was looking at this is, let me just zoom out a little bit. Whoops, too far. Let's get this here really quickly. 1, 2, 3, 4, and 5. So this is a classic example of a company that I would start following now, but I'm not really that interested in investing in it at the moment because not all of the ducks are in a row. Some of the ducks are in a row. I'm quite happy with the valuation, but not all of the ducks are in a row. The way I view the chart structure here is as follows. 5 waves up there. As you can see, a triangle there for a wave 4, completing off 5 waves. And if we have a look at the moves so far, it looks to me as though this could be an A, B, and a C on the downside. So this here could be seen as an A, a B, and a C of a wave A. and this could be working on a wave B before we get a wave C down closer towards $8.20. So this is a classic example of a company where I'm very interested in it. I think the fundamentals all stack up. The chart structure is suggesting that there might be more downside, and as you can see so far today, it's down 3.29%. So when I'm looking at Opera, yes, I'm happy with the current valuation, but the chart's telling me I might get a better opportunity at $8.20. So this is one that I'll continue to follow. And as you can see, there's a number of different variables that I really like about the company that keeps me interested. And that's what I find very interesting about Opera at the moment. So this is absolutely a play. Maybe over the next 3-6 months, I might do a deeper video going through the 10Q, 10K filing, but as you can see, the valuation stacks up, the business model stacks up. There are some downsides regarding ownership, but at the same time, we could probably let that go given the performance of the company over the past number of years. Management obviously have a good track record, and at $8.20, I think we could forego those risks for the potential upside. And I definitely think this could be an $80 stock long term. Absolutely. So Opera is a business that's been around for a while. The name is around for a while, but very similar to Nokia, the business is very different to what it used to be. It's involved in gaming, which is a growth market, AI content distribution, which with this new sort of creator economy, that's going to be really beneficial, because what I can do is I can go over and tap into their system and I can distribute my content. They'll distribute it for me among audiences that would be interested in it. So in this creator economy, that wing is going to grow, and they have a 13% stake in OPay, which if they integrate it into their browsers, could be a very interesting opportunity as well, with 370 million users. So when I look at this, I'm like, why is this trading at $1 billion? This should be trading at 10 or $20 billion over the next couple of years, in my view. So this is really in my view, this is the potential to be sort of a home run stock. So that is Opera. And then the last one is US Cellular. USM is the ticker. US Cellular is the same price it was back in 1985. However, I think that this here could be a very interesting play. Not a huge amount of top line growth, not a huge amount at all. But what I found really interesting about this specific company is the churn rate for US Cellular is 1.14% per quarter. To put that into perspective, the average churn rate versus their competitors in this space is 10 to 15% per year. The churn rate is extremely low at US Cellular, so they're doing something really right. And as you can see, while a number of telecoms have actually been declining over the last number of years, we've seen USM actually hold their ground fairly well, to the point where the valuations come down massively. So if we, and one thing that I really liked about this, the biggest thing I really liked about this, from the outset you're looking at revenue, yeah, it's not a growth company, it's fairly flat, but look at their margins, 15%, 17, 19, 20, 26, 24, 24, so we've seen margin expansion. Big margin expansion. They're focusing on 4 and 5G, and I think as we move into mid-decade, there could be a very interesting opportunity to maybe lease some satellites, maybe off Starlink or whoever is going to have satellites in the space, to increase their bandwidth, reduce their costs, and maximize their profit. So I think telecoms could be very interesting moving forward as we start to upgrade an awful lot of infrastructure. One thing that I noticed with US Cellular, and this is mind-blowing to me, I've never seen this before. Normally corporate debt has a maturity 15 to 20 years into the future. Guess when US Cellular's debt is maturing? $1 billion of the debt's maturing. 2069 and 2070. So what I found really interesting about that was, if you, and the interest rate 6.75%, which seems like a lot, but it's not really, because their total repayments per year is $21 million. So they're paying 2% repayment of that billion per year. If all they could do is get a return on invested capital of 5%, this here becomes a massive asset. I think they can do better than 5% personally. The reason why they borrowed more money was to obviously refresh some of their near-term debt, so improve their capital stack, push maturities way out, increase capital expenditure, and then for general purposes. So they are planning on increasing capital expenditure, but the repayment's only 2% per year, including interest of 6.75% over the next 50 years. That to me was a gangster play. I've never seen a company be able to do that before. But I guess when you're performing throughout a massive bear market, as this industry has, when you're performing like this, holding onto your top line and improving your bottom line, yeah, of course banks are going to come in and say, you know what, you guys know how to manage your cash flow. And wait till you see their cash flow. Cash flow is ridiculous. Cash flow generation in 2022 is 875 million. Have a guess why? They retired some near-term debt and they extended maturities into 2069 and 2070. So if you can imagine, let's just pull up a calculator. Let's say I borrowed $100, and let's say I'm going to pay that back over the next 10 years. Divided by 10, I have to pay back $10 every single year. Let's say I borrowed $100, and let's say I pay it back over 50 years. So divide that by 50, I pay back $2, not 10, $2. So they retired some of their shorter duration debt and extended the maturities 50 years out. What does that do? Increases their cash flow. So when you're looking at the balance sheet here, the free cash flow generation went from 197, 74, 248, 821, 875. Why? Took $1 billion of debt and extended the maturities out 50 years. Incredible move to increase near-term free cash flow and give the company optionality in order to compete with their competitors. Fantastic move. What I really like about the company is they're gearing up for a growth cycle and they don't pay a dividend. They don't pay a dividend. And I like that. So you have 821 million and 875 million in free cash flow over the next 2 years and there's no dividend. So all of that should be put into capital expenditure. Compete with Starlink. Why not? They can do anything. We're buying the optionality of that cash flow. So into next year, the cash flow is going to be $875 million. So 875 is what they're going to generate next year in cash flow. Let's see what their enterprise value is today. 6.6 billion. So if we take, divide this by 6601. It gives us a 13.25% free cash flow yield. That's a fantastic free cash flow yield. If you're looking at it relative to the market cap, wow, it's like a 25% yield. I normally like to look at it against enterprise value because that factors in debt. But the interesting thing about this is we know that 1 billion of that 3 billion in debt, because that's the difference between the market cap and enterprise value, 1 billion of that debt is extended 50 years into the future. That to me is incredible. That's fantastic management. Incredible management. So we don't need to worry about the debt. And if we're looking at the free cash flow relative to the market cap, it's like a 25-30% yield. Absolutely incredible. They don't need to pay down any debt at all. It's extended 50 years into the future. And to anybody that is lazy enough to open up this company, head straight over to the balance sheet, look at the market cap at 3 billion, and then look at the total debt and see 3.9 billion and say, wow, too much debt. To anyone that's lazy enough to do that, they don't deserve to get an opportunity like this. Because again, I've never seen it. I've never seen a company able to extend their debt 50 years into the future. Again, as of right now, I'm following this company. To me, it doesn't look like a buy right now from the chart perspective, but it is one that I'm following. And again, I might follow it for months before I take a position. But when I overlaid like my bullish expectations with a chart structure, this is what I come up with. So this is the weekly chart. This is going back to the 1980s. And as you can see here, this is a beautiful triangle. That's the first thing that I noticed. Beautiful triangle. From there, we shoot higher. We know that that's a triangle, so it would have to be a wave 4. Shoot higher, that would be a 5th wave. Now, we broke down in 3 waves, so I marked that out as a wave 4. Why did I mark it out as a wave 4? Because we then have a 5-wave structure on the upside. 1, 2, 3, 4, and 5. So that there's an impulsive. So that's the start of a new 5-wave structure. So triangle, 5th wave for wave 3, pull back in 3 waves for wave 4, 5 up, general direction of the trend. We should correct. From there, what we have is a flat correction, A, B, and C, and then we have A, B, and C for wave B, 1, 2, 3, 4, and 5. So on a weekly chart, this here is turning around. It's turning around at a time where the free cash flow is expanding to 13.25% of enterprise value and 25 to 30% of the market cap due to a nice bit of business. As well as that, they do have a decent amount of cash on their balance sheet. If we actually have a look at the cash, they've got $500 million in cash. So they do have some decent cash on their balance sheet, but the free cash flow generation is what makes it very interesting. So when we're looking at a company like US Cellular, to a lot of people, this might look like a dead business, but to me, I'm looking at what the management are saying. We're going to increase capital expenditure. We're going to become more competitive. We're going to focus on 5G, which is a growing industry, and we're going to compete over the next 5 to 7 years for market share. Then I look at their churn rate, 1.14% per quarter, which is way, way, way below industry average, which was 10 to 15% per year. So 1.14% per quarter is significantly below there. So the churn rate's really low, meaning that as of right now, they're good operators. That's clear from the top line revenue, remaining flat in a bear market, and margin expansion. And at the same time, the management have proven to us that they're good operators by extending maturities 50 years into the future. I would love to know what bank gave them 50-year maturity, because I would short the crap out of it tomorrow. That is the silliest thing you could ever do. Even more so when you've just seen CPI of 5%. So the real cost of that debt with CPI of 5% is 1.75%. It's absolutely incredible. So I think what they done was a fantastic bit of business. I'm really excited about this company, but the chart structure in the near term still looks a little bit ugly, and I'm not sure that it's bottomed out just yet. Sentiment in this space hasn't really turned around at the moment. It's still a little bit up in the air. Sentiment really hasn't turned around. It might be a little bit of a headwind in the near term. As of right now, I'm thinking that this here might be a wave 1, 2, 1, 2, 3, 4, 5, 4, 5 for a wave 1 within 5 on the upside. When I work back, if they can achieve 7% top line growth, which I don't think it's crazy by listening to the management, reinvesting, stealing market share in 5G. I don't think it's crazy given the amount of cash that they have, the free cash flow generation. Could they get up to 7%? I think so. And if they're growing 7% in 2023 into 2025 for 5 years, and we slap on the average multiple, so if I get a valuation, so I've taken the average multiple over the last number of years of 6.22, which is in and around where we currently are. I think I've taken 6.5 actually. At a multiple of 6.5, that gives us a target over the next 5 to 7 years. I've got it marked off here of $239. So it might take 5 years, 6 years to get up there. You're currently paying $35 for this company that a lot of people think is dead. So over the next couple of years, this could actually turn into a growth market. And everybody's focused on way overvalued companies when companies like US Cellular kind of reminds me a little bit of Nokia, where everyone forgets about it. Everyone forgets about these companies. But this is looking really interesting. Really, to me anyway, if you have a little bit of an idea as to where we're going to go in the future, these type of companies become really interesting. And this is what really excites me about trading and investing, is you get to find these hidden gems, and when you go through their balance sheet and you see the opportunity, it's super exciting. But US Cellular is one that it might take me a couple of months. It might even take me a year before I put a position on the table, but it's one that I'm closely watching. The chart is stacking up on a weekly time frame. Lower time frames are a little bit more questionable. The valuation and the operational skills of the management, I'm really impressed by. Yes, there is debt, but the maturities on that are 50 years out. Free cash flow generation of 875 is 13.2% free cash flow yield on the enterprise value. But in this circumstance, because of the maturities are so far into the future, I think that we should probably be looking at, the market cap, because they're only repaying 2% of that debt of $1 billion, which is very, very, very low. So the risk with their debt is not a huge amount. So yeah, I think we're getting to a point where we could see these type of wild moves here in US Cellular just when everybody forgets about it. Right, so yeah, from a chart perspective and a fundamental perspective, it looks really interesting. So there are 3 companies that I'm following at the moment. Very interested in all 3 of them. Normally I wouldn't do an update like this because I'm not ready to take a position in any of them. But as you guys can see from all of the data points, there's interesting parts about all these different companies. And it really comes down to just following it, listen to management, looking at guidance, seen as a probable, following valuation, following charts. And at some point, it's just like, okay, it's too hard to ignore. Let's take a position. And if we missed it, you just kind of delete it off your watch list and move on if it ends up taking off without you. There's plenty of opportunities out there. So anyway, guys, I'm going to leave it there. Hope this update was helpful. Just to recap, we had 3 companies today. We started off with Toll Brothers, ticker TOL. We moved on to Opera, ticker OPRA. And then finally, we had US Cellular, ticker USM. So with that said, guys, have a wonderful day, and hopefully you guys are all knocking it out of the park this week. So all the very best, guys. Peace.